Now, turning to the property market, and just reviewing some of the trends that have emerged over the past year and what they tell us about what might be coming going forward, there were some surprises. And one of the surprises, in fact, was perhaps that house prices bottomed out sooner and indeed started to rise and rebound again, it seemed, over the second half of last year. Who would have thought 12 months ago that 2009 would end with house prices showing a positive year-on-year gain? Not very many people at that time, certainly not the people in the derivatives market. And we saw a rise, a pickup in activity in mortgage approvals and in transactions, although you can see that it was from a very low base, and we're not getting back to anything like the levels of activity in the market that preceded the downturn. And indeed, January's numbers were down after the end of the stamp duty holiday, and there are increasingly a number of question marks being raised about how sustainable this upturn may be going forward. One of the issues, looking a little further ahead, clearly is that the capacity for mortgage lending has been hugely supported by the special liquidity measures and other initiatives that were taken in the downturn, which are due to run out. And the Council for Mortgage Lenders has indicated that with the wholesale money markets still operating in restricted fashion, there is a serious potential for shortfall in mortgage lending capacity going forward, which may have an impact. But more fundamentally, the other things that sort of slightly worry me and give me cause for pause and a little concern about the state of the housing market is the extent of the correction in house prices that has occurred and whether that leaves the market in a somewhat vulnerable position. And we look at this chart, which is showing the trend in real house prices on a long-term basis and the movements in house prices around that trend, will show that the fall in house prices that we've experienced has basically done no more than bring those real house prices back close to the long-term trend, now with signs that they're starting to rise again. Now, there is clearly scope for a further correction, as we've seen in previous downturns, which would, for a while, take house prices below the long-term trend. That's the point about the long-term trend. There is movement around it. This looks to me, if I can be a bit controversial, like a half-baked correction which could have another leg to it. And I'm further made cautious by looking at a different measure of affordability of house price to earnings. This is for first-time buyers. Again, there has been a correction, but it's left that ratio still well above its long-term average. Indeed, it's only come back. The average has some degree increased over time. It's been higher over the past 10 years, but we're only back to the average of the last 10 years. Now, I'm not predicting here a further downward movement in house prices, but it seems to me that in this pricing situation, relatively speaking, a vulnerability to further shocks, to a further weakness maybe in mortgage lending, is quite high. In the house building sector, as been noted, we have seen a very sharp downturn in activity, and you can see that last year housing starts really plummeted. I think, in fact, if I'm right in recollecting, this was the lowest number of housing starts, remarkably, since 1946. And while construction industry forecasts do expect some pickup in house building activity over the next 2 to 3 years, you can see there that in terms of the level it was expected to get to, we are still way, way below the average of recent years, let alone this target of 240,000 houses per annum, which has been decreed by government as what we ought to be aiming for in terms of securing an adequate level of housing supply. So serious issues, I think, coming out here in the housing market. Now, in the commercial property market, interestingly, we have had a far more severe price correction, value correction, than occurred in the housing market. A cumulative drop in the investment value of commercial property from the middle of 2007 to the middle of 2009 of 44%. You see there that capital values had risen far in excess of the growth in rental values in the boom, basically through the compression of yields, of investors paying more and more and more for the same income stream, and the correction in turn has been far more dramatic than that which has occurred in rental values, which are still drifting downwards at the present time. But since the middle of last year, we have had something of a rebound. We've had more activity in the investment market. We've had more investors coming back into the market, and values have risen. Indeed, in the course of last year, there was a remarkable turnaround in the investment market with a renewed inflow of money into institutional managed and pooled property funds, as you can see there, towards the end of 2009. As basically investors quite suddenly judged that property had repriced, was now offering better value, and a lot of money came into the market. There was also significant investment from overseas in the central London office market, also more activity by private property companies. Quite a sharp response to a repriced market. But in that increased investment activity, there was a strongly selective focus, there has been, on where the money has been going and what it's been focusing on. And basically it's been focusing on better quality assets, offering the most secure income, occupied by stronger tenants, and being in good locations, being essentially towards what we call in the market the prime category, the best tenants, the best locations, the best buildings. And so the values of prime or better quality buildings have appreciated in this period much faster in this recovery than values of lesser quality, or what we call secondary buildings. And this is illustrated here in this differential between benchmark prime and secondary yields, where you can see that the gap between these two has widened very, very significantly. There's a much greater differentiation now in the valuation of property between good and less good, if you like, the more you move up the risk spectrum. Now this is very significant, obviously, with respect to the prospects for regeneration projects and property and regeneration, because by definition they lie higher up the risk spectrum and are therefore likely to be valued less positively in this present environment, which may now continue for some time. People are now talking that this establishing of a wider value and pricing differential between prime and secondary property is going to be an ongoing and consistent feature of the market. The other factor overhanging the outlook for the commercial property market and investment and development also, again, is debt. Again, we've talked about household debt, we've talked about government debt, and we've got an awful lot of debt out there in the property market. This huge mountain of debt that was built up in the investment boom, about 250 billion as tracked by the Bank of England, but there's more from other lenders who don't report to the Bank of England, taking the total probably to about 280 billion. It's about 16 or 17% of total commercial lending by banks in the UK, a very, very large exposure. So we're sitting under debt mountain at the moment, and that has a number of implications for the market. One, the sheer scale and need for refinancing. About 140 billion of loans to the UK property sector are due to mature in the next 3 years. That's an awful lot of financing. Now that includes quite a few loans that were actually due to mature in 2008 and 2009, but refinancing has just been too difficult. A lot of this lending is being rescheduled, loans extended and rolling forward. But somewhere out there, there is still a substantial financing need.